Financial management for organizations is a subject that is often overlooked, including that of veteran service organizations. While it may not appear to be an exciting subject, unless you're in accounting or elsewhere in the realm of financial management, efficient and ethical financial management is imperative for human service-based organizations to thrive and remain sustainable in the long term. While there are abundant resources for grant writing and fundraising, we're going to focus on the management side of finance as there aren't many resources that emphasize this enough for human services or VSOs. One doesn't have to become a finance subject matter expert, but you should walk into program management with at least a basic understanding regardless of your position. What we're going to discuss today includes an overview of the significance of financial management, personal finance and mindset, organization and program structures, financial analysis, budgeting, performance analysis, cost analysis, profit and loss forecasting, risk management, fees, government contracts and grants, foundations, and auditing. So what is financial management? Financial management is a process of identifying, measuring, and maintaining an organization's financial resources to meet its service objectives. Financial management for organizations is a discipline that requires knowledge of how money is acquired, invested, saved, and spent. VSOs are often founded with good intentions, but what happens when they become too big or when the mission shifts? Financial mismanagement can lead to decreased donor giving. If donors cannot trust their dollars will be used appropriately and wisely, they will withhold funding and shift their attention elsewhere. Financial mismanagement can also result in fewer donor prospects where donors may decide to steer clear from VSOs or related organizations because of financial mismanagement. Allegations of fraud. Financial mismanagement is a red flag for corruption because it's often indicative of unaccounted expenditures. This can result in government investigations and other forms of scrutiny. Your organization may also have to pay fines or go to court if you are accused of any wrongdoing. Employee embezzlement. When employees feel they aren't being paid what they're worth, they may resort to taking from the organization to compensate for their lack of financial gain. They could also steal funds by overcharging clients or engaging in double billing. Loss of community trust. Much like donors, once your organization's reputation goes, so does everything else you have to offer the community. It's difficult to repair organizational and professional reputations, so your leadership ethos is directly tied to how your organization is managing its funds. It's not enough to leave everything up to a CFO or an executive director. It's imperative that managers and stakeholders know where the money is going and how it's being spent. For these reasons, organizations should establish robust internal controls that include checks and balances at each level. Financial management should be an ongoing process that all available resources, including volunteer, staff, and board time, are devoted to. In terms of VSOs and related organizations, it is the translation of financial matters into meaningful and relevant information for management and policy leaders. A few terms that would behoove you to be familiar with here include the Government Performance and Results Act, or GPRA, of 1993, and the Modernization Update in 2010, which requires all federal departments and agencies to annually report performance and cost data to the U.S. Congress, and now agencies are required to identify key factors external to the agency and beyond its control that could significantly affect the achievement of the general goals and objectives. Agencies and organizations must adopt financial management tools such as performance budgeting, program budgeting, and cost analysis for accountability purposes. Personal finance involves planning for your future. It can help you make informed financial decisions. Financial managers should always consider personal finance as they plan long-term goals for their organization. Financial managers must also consider personal finances when budgeting and allocating funds, whether it be to pay bills or invest in assets. Financial managers are responsible for making sure that the organization is financially secure. Financial managers are not only managing finances, but are also maintaining a family's well-being by ensuring there is enough money saved for retirement, college tuition, etc. Financial managers should ensure that both individual and organizational financial needs are met through careful consideration of risk management practices, diversification of investments through different asset classes, liquidity of assets, or the ease of which an asset can be converted into cash, and prudence in spending. Personal financial management starts with not only spending and paying bills, but it has a lot to do with preparing for retirement, building up savings, and responsible financial management at home. If this is not achieved in your personal life, you may have difficulty in making the appropriate decisions for your organization. Organizations, including program managers, should also keep up with, understand, and help implement any new laws or regulations that apply to financial management decisions. You should always be aware of the current tax laws as they pertain to different transactions. Program managers, through organizational leaders, should ensure they are able to respond to most questions about their organization's finances succinctly and accurately. Financial records should reflect accurate information on budgeting, investments, taxes, and profit and loss forecasting, or how much money is coming in, but also where it is going in the long term, whether that is in the next 5 years or more. Organizations must also consider, or always consider, the future while making today's decisions. Financial management is an important topic to organizational management. Therefore, you should examine your personal finances first to ensure that habits don't leak into overspending or mismanaging money in your organization. In short, financial responsibility starts with you by setting an example for others to follow. Have you or anyone close to you ever said the following statements? I work so hard and I still can't make ends meet. I'll never be able to afford a vacation. I'll take what I can get for this project, even if it's not my full rate. You don't understand what it's like to struggle. It's the story of my life. Much of this is associated with financial trauma, which is also covered extensively in the realm of financial social work, but this is something to consider in resolving any current issues you or people close to you may have. Financial trauma is a term used to describe the damage and stress caused by financial problems and is associated with possible symptoms of post-traumatic stress. Financial trauma can affect physical well-being as well as emotional health, as evidenced here in the figures in this report. Financial problems such as bankruptcy or unemployment can cause sleeplessness, depression, and high blood pressure, and can affect individual and family mental health in the long term. Financial trauma often causes individuals to neglect one's health, poor sleep hygiene, and overstressing the mind leads to various manifestations in physiological forms. Financial problems can also cause interpersonal disputes and is one of the leading causes of divorce. People and organizations should also factor in how their decisions will affect employees' personal finances when making organizational decisions, because it could have huge consequences for workers' personal lives. Financial managers should also consider that financially traumatizing employees could lead them to not caring for the organization's future as much as they would if they were not financially traumatized. Financial trauma affects organizations of all kinds, such as large corporations and small businesses, nonprofits, government agencies, religious organizations, etc., but can also be avoided through careful planning. Both individuals and organizations should always make decisions based on their long-term goals, because short-term goals can cause financial trauma for everyone involved. When we grow up in low-income households and struggle with food and shelter insecurities, one of two things can happen for us when we grow up. We overcompensate in our finances or engage in overspending. This is financial trauma. In this video, this therapist discusses what it looks like day to day and how to help ourselves manage it.